Hello, test, test. Can you guys hear me? Alright, anybody not know where to go? I guess you guys that are watching, you know where to go. I'll get going in 1 second. I just want to make sure nobody's having any issues with anything. Alright, cool. So tonight's webinar is just based on questions I received from you guys over the last couple of days, and I'm calling it a mailbag webinar. Just got some answers here on a Word document. This will be recorded, and the Word document is a file that I can send you if you want it to review for yourself after this webinar is over. But so we're just going to jump into it. I will save time for questions at the end or chart reviews if you guys want to get into that stuff. But so yeah, without further ado, we'll get started. So thanks for attending. So first question, one of the questions I got from a new trial member was, what is the best way to succeed as a subscriber to my site? And first and foremost, you have to commit to learning. You know, my service is for people who are very serious about becoming great traders. It is not a passive service. And it starts with you showing up to my sessions by 9 a.m. Eastern if you can make it. You know, maybe you have your job one day or family commitments one day, but you need to be able to get there by 9 a.m. more times than not so that you don't miss anything pre-market. Because if you want to be successful, you have to put in the work. And this is if you were trading with me or if you weren't trading with me and just trading on your own. You got to put in the work. The biggest mistake I see people make, whether it's with me or on their own, is they think they can check out the market 5 minutes before the open and still be successful. And it doesn't work like that. You know, the analogy I would say is that Michael Jordan didn't show up to a game 5 minutes before tip. So we shouldn't show up to the market 5 minutes before the open. Secondly, you need to ask questions. If something doesn't make sense, ask me, and I'll do my best to help you understand. You got to take advantage of the educational material that's posted on the site. I started the site over a year ago, and everything has been recorded to that point. So there's literally over 1,000 hours of live trading footage in the live trading archive, which you can find from the site. Over 1,000 hours. I think that's very important. And there's a number of educational videos in the video library. You need to watch them. I learn something new every single day, and I'm always talking about it. So you need to watch the sessions in the evenings or on the weekends, because that way you'll hear some of the educational talking points that you might have missed during the heat of the moment. You know, I'm in a trade, it can be stressful, maybe we're excited, and things are moving fast, whatever. So maybe you missed something. Go back, watch the film. Just like athletes watch film of how they play, we have the benefit of being able to watch live market action play back. Most importantly though, you need to stay comfortable at all times. Sometimes I will talk about a trade idea, but I won't execute on the trade myself because it doesn't fit my style personally. This is why I'm always saying stuff like, if you want to be aggressive, here's a trade setup. Or the more conservative approach is to wait for XYZ to happen. You know, I try to call out these ideas to help you figure out what type of style you want. I'm generally more conservative than usual. So if I talk about a trade but I don't enter it, that doesn't mean you shouldn't enter the trade if you like the idea. If you like the idea that I throw out there, figure out a way to put some risk on, regardless of what I'm doing. What I'm doing shouldn't matter. You need to look at the idea and say, hey, yeah, maybe he's onto something there. And if it fits your risk appetite, figure out a way to put something on. Maybe I enter a trade that you don't think makes much sense. Maybe I do something and you say, man, this is a little too risky for me. I'm going to wait this out, see how it plays out. That's what you should do. Do not ever get in a trade with me that you don't understand or you don't think makes sense or you think is too risky. Stay away from those types of trades, because even if it does work out for me and you will have learned nothing other than to second guess yourself. So you have to be comfortable with your trade, not my trade. This is the only way to learn what type of style suits you. If you aren't comfortable with your own trade, you will never learn when to listen to yourself or not. And as a result, you will always be less of a trader than you can become. Think about it like this. If you make a mistake based solely on my actions, you can only learn from my mistake. But if you make a mistake based on your actions, you can learn from it yourself. My goal is to help you become the trader you want to be, not just simply copycat my trades. And one thing I really want to stress with this is the whole concept of listening to yourself. When you get that itchy trigger finger type feel, like, man, I think I should get in here, you don't need me to encourage you. Maybe it feels good if I'm thinking the same thing as you, but really you need to pull the trigger when you feel like you should pull the trigger, because that is how you'll learn if you were correct or not. If you pull the trigger and you end up being right, you know that the next time you get that itchy trigger finger, you can trust yourself. But if you don't pull the trigger and it ends up being right, then you're hesitating and now you're second guessing, and it's going to hold you back on the next time around. Or maybe you pull the trigger and you end up being wrong. That's fine, but at least now you know, hey, next time around that I get that itchy, aggressive trigger finger, don't be so aggressive because it didn't work the first time, so maybe it's not going to work this time. But the bottom line is unless you're listening to yourself, you're not going to be able to understand what type of trader you want to be. Another question I got is on what is my favorite type of setup to trade. I've got 3 favorite setups to trade. The first one would be the washout off of a high for a long trade, or the straight up move for a short trade. Netflix actually just today kind of had both of these. So what I mean is the straight up move. You look at this chart here and you come from 111.60 up to 113.80, and I just call that kind of straight up action. You had 6 green candles in a row on a 3-minute chart. As a rule, anytime I notice 5 green candles in a row on a 3-minute chart, I start looking at this for a scalp short trade. And you can see on Netflix it did so perfectly. Topped out 13.80, ended up pulling back all the way to 112, and then it gave me my other favorite type of move, the washout off of a high. So first we had the straight up move for a scalp, and then we had the washout off of a high for a long trade, where you just kind of go straight down. Again, you look at this was even 8 red candles in a row on a 3-minute chart. I started going long today right around here, about 112.40. Ended up dipping a little bit lower, but still, after all, an hour later the stock was significantly higher, went from 112 back up to 113s. This is my favorite setup to trade. When you get this straight move down on a stock that had just made a move higher, especially on Netflix, which is generally an uptrending stock. The key with these trades is they're typically very short term, and you typically need to have a very tight stop loss. So these types of setups are not going to be for everyone. It's a lot of level 2 interpretation, which we'll go over a lot of level 2 stuff later on in this webinar. But so that's number 1. The washout off of a high for a long trade, or the straight up move for a short trade. Both quick short-term trades usually have high probability and low risk because you can just kind of trade it versus continued highs or trade it versus continued lows. And again, the rule for me is anytime I see like 5 green candles in a row or 5 red candles in a row on a 3-minute chart, I start paying attention close to try and catch the top or catch the bottom. My second favorite setup is when we gap down in the stock, but we don't break to new lows. Or when you gap up, but you don't break to new highs. So you can see here on this chart for Netflix, this is back from October 19th, so a few weeks ago. We had a gap down in the shares, and you look at this initial low right here. This is a 15-minute chart. You gap down, and then look later on, 30 minutes later, you try to break that low, but we had a failed breakdown to new lows. So anytime that you are at the low and you can't break down further off of an opening gap down, then I start thinking, okay, maybe this thing's going to reverse. And your setup is then versus the low a day action. So you made a new low, but immediately popped right back up into the range on the day. You see? And then you start kind of curling back up here. So I look at the long trade right here and then trade versus this low a day. The opening gap down that doesn't break to new lows usually sets up a nice long trade for a reversal higher. My third favorite setup, and the one that I have the hardest time trading myself because it requires the most patience, but it is the best in terms of reward, and that is the breakout or breakdown of 15 and 60-minute highs or lows, where then those 15-minute and 60-minute highs or lows act as support or resistance. This is a 15-minute chart of Amazon from November 4th last week. Stock was around 630, and you just have a nice clean move here on the 15-minute chart, and it's playing out on level 2. And the first thing I want to show is you get a great pop, 628 up to 634 right away in this first 15-minute candle here. And notice how then in the 30, 45 minutes that follow, the share price stays at the top of the initial 15-minute high. So we have these two horizontal blue lines here as kind of where the high of the first 15 minutes worth of range occurred. And you look at the price action, it all stayed right up there. So that shows you, okay, the stock made a good move higher first 15 minutes of the day, and now it's holding on to that move higher. And then this first arrow, you can see we break out above that high. And then once you break out above that high, notice how we then hold this horizontal line, this second one here, as support moving forward. And then you just kind of repeat the process. Another breakout above the 15-minute high, and then you act, and then that 15-minute high acts as support on the breakout. And you just keep on going all the way until about 1 o'clock when the price finally fails to hold the previous 15-minute high. And that was a good signal that, okay, this trend is over, and you can see we started going sideways off of that. But check this out. Then we declined into the close on Amazon. But notice where it found support right here. It found support right at the initial high from the morning session. You look at this action here. This is from 9:30 to 12 o'clock. And then you stretch out that 12 o'clock high. And that's exactly where the price found support into the close. And then the next day, you gapped higher. Maybe it's a coincidence you gapped higher. Who knows? But the bottom line is risk and reward. We did see that morning high, that's what would be the 9:30 to 12 o'clock high on a 60-minute chart, act as support. So I really like when in the afternoon session you have a little washout back to that morning high on a stock that's been uptrending like Amazon had been this day. I think it sets up a decent bounce play. And in the morning, when looking in the immediate term, I like when you get a trend that's just continuing higher, breaking above previous 15-minute highs, and then turning those 15-minute highs into support like Amazon did here. So to recap, my three favorite setups are what I call washouts, either washouts or straight ups, where you wash out to lows and you set up a bounce, or you move straight up to highs and you set up a little pullback. Number two, when you get a gap that fails to break in the direction of the gap, I like it for then the opposite directional move. So in this example here, Netflix gapped down, but then as the morning progressed, 30, 60 minutes in, it was failing to break down to new lows in the direction of the gap down. So we're going to look at it for the opposite move, which ended up being a nice move higher. And then lastly, this move where you just set up a nice trend on 15-minute highs, keep breaking those highs, and then those highs act as support on any dips. couple different styles here. So this trade, the washout and the straight up, this is great for the scalp trade. This is generally going to be a scalp trade where it can really pay out quickly and efficiently. The second setup is more of a wait and see breakout type trade, or a non-breakdown type trade, a reversion type trade, whatever you want to call it, where you're kind of betting on the opposite effect, again, where you're not able to sustain a breakdown or you're not able to sustain a breakout, and it's kind of a bottom picking or a top picking type strategy off of gaps. This third one is great for swing trading. It requires the most patience. You can see if you've got the patience, Amazon went from 630 up to 644 without ever really breaking any supports, and that's a nice clean move. But you got to be patient enough to hold for 3.5, 4 hours there, which I struggle with currently. That's the thing I need to get best at. So these are just good though for helping you identify your style. If you want to be a swing trader, you need to look for these 15-minute type patterns. If you want to be more of a scalper, look for those washouts and straight up type moves. Next question. Is one day better than the other for trading options? This is a subjective question, and again depends on your personal style. If you like being able to make a lot of trades with the chance to make 20% each time, then Friday is the best day for options trading. Why? Because by the time Friday rolls around, there are many liquid option strikes that have little to no premium. So that means that the strikes will move very directly in relation to the stock price. So every little move in the underlying stock is moving the option strike 10 to 20% at a time. If this doesn't make sense, give me 2 more days. It'll be Friday. We'll see a lot of this, and we're going to talk about it more at the time. If you like to short options, then Monday and Tuesday are usually the best days to trade options. And that's because option prices typically have their greatest amounts of premium on Monday and Tuesday. And when we're shorting options, our goal is to collect a favorable amount of premium. And the prices of options on Monday and Tuesday allow us to do that. As you get closer to Thursday and Friday, there's less and less premium on options, so shorting them becomes less favorable. But again, just kind of depends on your style. Do you want to be really short term? Do you want to be more of a swing? The quick, fast stuff is going to be happening on Fridays. The slower, more trend pace type stuff is going to be happening on Mondays and Tuesdays. Good question. I'm glad somebody asked this, and that is, what is happening when you short premium? This is something I do a lot of, especially on Mondays and Tuesdays, and it can be confusing to understand, but the simplest way to think about it is that mechanically, shorting premium is the exact same thing as shorting a stock. So for example, in terms of shorting a stock, if you have an account balance of $30,000 and you short 100 shares of stock XYZ at $100 per share, you are collecting $10,000 in credit, since you sold or shorted the shares, and $100 times 100 shares equals 10,000 bucks. So we collect the 10,000 bucks. It increases our balance to $40,000 while we're short. Then if the share price goes to $95 and we decide to cover the 100 shares and buy them back, it costs us 9,500 bucks. That would result in a new account balance of $30,500. Since it only costs us $9,500 to buy back, we get to keep the $500 difference from the original $10,000 worth that we sold. So you have effectively increased your real account balance from $30,000 to $30,500, reflecting the profit of $500 you made on the short sale. In a losing scenario though, let's say the share price goes to 105 and you cover the shares and you cover the 100 shares at 105. This would cost us $10,500, and that would result in a new account balance of $29,500, since it now costs $10,500 bucks to buy back. So you have lost $500 from your original account balance of $30,000 bucks. This table shows it more clearly. So we've got our account balance. Our starting account balance is $30,000. After we short 100 shares at 100 bucks, our account balance is $40,000. We've borrowed the shares and collected 10,000 bucks, so we've increased our account balance to 40,000. Then if the shares go to 95 and we cover, it costs us 9,500 bucks. We close the trade, Our new account balance is $30,500. We've profited by $500 because we got to keep the $5 difference between 100 and 95. We don't have to give it back. However, if we have a losing trade and the shares are at 105 and we cover them, now we have lost $5, so we've lost $500, so our new account balance is $29,500. Now you ask me what's happening when you short premium, so why am I talking about stocks? Well, it's because it is the exact same concept when you short premium. So when we short an option, the same thing is happening. If we have an account balance of $30,000 and we short one XYZ option for $1, we collect $100. This increases our account balance to $30,100, and if the value of the option goes to 50 cents, we can cover it for 50 cents, which costs us $50. This means we get to keep the other $50 we originally collected between the difference of 100 and 50. If the value of the option goes to $1.50 and we decide to cover it at a loss, though, it costs us $150, and that means we lost $50 on the original transaction. So again, our account balance, our original account balance is $30,000. After we short one option at $1, we collect $100, so our new account balance is $30,100. If the option goes to 50 cents and we cover it at 50 cents, now our new account balance is $30,050 because we collected $100, we only had to buy back $50 worth, so we get to keep the $50, so that increases our account balance by $50. That's how much we profited by. However, in a losing situation, our account balance after covering the option at $1.50, now we had to pay more than what we collected. We're paying $150, we only collected $100, so we're losing $50, so our new account balance is going to be $29,950. Here's a trade I made this week where I did short premium. This was a real trade. Those of you who were watching on Monday saw me place this trade. And I shorted the Netflix 106 strike put at 69 cents. So I collected $69. And then yesterday, I bought it back for 25 cents. So I made 63% on that. I shorted the 106 put option for 69 cents, so I collected $69, and then I bought it back one day later for 25 cents, so I paid $25. This resulted in a net profit of $44. 69 that I collected minus the 25 I paid to buy it back equals 44. That's how I'm getting that. What I like about shorting options personally is you can bet on something not happening. For instance, all I needed with this trade is Netflix not to go below 106. It was at like 110 at the time. I didn't need Netflix to go up. I didn't need it not to keep going down. I just needed it not to keep going down dramatically and go below 106. It could go to 107, it could go to 108, it could go to 109. I'd still make money. It could even go to 106.01 and I would still make money. Where I would have been in trouble is if by the end of the week Netflix was below 106. So that's why I like shorting options, because I'm not needing something to happen in order to make money. I'm needing something not to happen. I'm betting on a low probability outcome not ending up being the outcome, if that makes sense. So that's why I short options. We'll learn more about it. We'll have a webinar coming up soon actually on more details about shorting options. But so that's the mechanics of it. That's what's going on there. What do I think of having a daily profit goal? I think it's a great idea, and especially if your aspiration is to be a day trader. If your desire is to be more of a swing trader, then maybe it's not going to be a daily goal, but more of a weekly goal or a monthly goal, whatever. But the key with your daily profit goal or your weekly or monthly is it should be more about being realistic and less about being challenging. This is just my personal opinion. If you have no track record of making consistent daily gains, then you shouldn't set a goal to make $500 per day. I swear to God, that's the most common thing I hear when I talk to new guys. I say, well, what's your goal? And they say, I'd like to be able to make $500 a day. I say, well, have you ever made $500 a day in the market? And they say, nope. And it's like, okay, well, let's try and start with a lower number that's actually more realistic. So you got to set a goal based on your track record. That's step one. So start small, work your way up. Personally, my goal is to make $65 per day. and I'm not reaching this goal consistently enough yet. I reach this goal about 40 to 50% of the time, 2 to 3 days per week, and I'm not going to raise my goal until I can make $65 per day every day for 60 days straight on average. And the on average is important to note. I think you should be fine with accepting a losing day here and there. The key is what does your daily profit look like averaged over a week. So for instance, if you make $500 Monday through Thursday, but then you lose $100 on Friday, you still made $400 on the week and averaged an $80 daily gain each day of the week. So in that scenario, I would have reached my goal. Even though I didn't make my $65 on Friday, I still averaged $80 per day on the week, and that's good. I think you focus on the $80 daily gain per average on the week, not the annoyance you have from failing to go green 5 out of 5 days. You got to accept the fact that you're going to have winning days, you're going to have losing days. Ideally, we want to have a winning day every day, but when it doesn't happen, we need to look at the course of the week and average it out and see how did we do. I came close to reaching my goal of 60 days straight, actually, in September and October, but I was only able to average $51 per day, which was an improvement over July and August, but still not where I needed to be, and I kind of felt myself pressing to start this month of November, to be honest with you, so I just kind of had to remind myself just today to kind of stay steady, focus on those small accomplishments, and they will add up. And again, for me, I'm trying to do it for 60 days straight. I just like judging myself in 2-month increments. So like I compare my September, October average daily gain to my August, July. I compare August, July to June, May, etc. Next question. Do you have any allocation rules and or just general trading rules to live by? The first rule I have, which deals with my allocation, is my 35 rule, and this is that I should never have more than 3 to 5% of my total portfolio value in a single options trade. It says single trade. This is a single options trade. Currently, my account value is around $33,500. So this means my principal should never really exceed $1,000 to $1,600. Most times I don't even have that much exposure per trade, but when I get close, I become very conscious of my 35 rule. With equities, it's a little bit different because you don't have the same risks with equities as you do with options. So I will allocate more. I will have more exposure. But even then, it's very tight stops and never going overnight, strictly day trades. Anytime I'm going to put on a big scalp position with an equity trade, it would probably be about $5,000 to $10,000 per trade. A couple rules that I have is I always try and place my buy order below the bid and place my sell order as soon as I fill. This eliminates a lot of the guesswork. I find when I don't have a sell order in, I'm kind of prone to reading into every single tick, which causes me to overanalyze. And when I put that sell order in, it's like I'm eliminating half the battle. If I put the sell order in, now the only chance I have at hesitating is canceling the order and changing it. But if I first put it in, now I can't hesitate. If it gets filled, it gets filled. That's great. I used to find that I'd try and time things exactly correct, and what would happen is I'd overanalyze, I'd read into everything, and I'd find myself selling into the bid as opposed to selling on ask, which just makes it easier if you've got your sell order in as soon as you fill. A couple personal beliefs is that the open is the best time of the day to trade. If I don't make a trade within the first 5 to 30 minutes of the day, then it's probably not going to be an active day. Barring news-related moves or unusual market environments, then the greatest volatility will typically come the first few minutes of the day, as well as the best volume. Something I remind myself is that I would rather be naturally conservative and know when to be aggressive than be naturally aggressive and know when to be conservative. There's a typo here. Let me just fix that. I just think it's safer to be conservative. Sometimes my conservatism keeps me out of a winning trade, but that's fine. To that same end, my lack of aggressiveness keeps me out of losing trades. I feel like when I'm doing well consistently, it's because I'm being generally conservative, and when I'm doing poorly, I feel like it's because I'm being a little bit too over aggressive. So I generally think it's easier and better to be naturally conservative and know when to turn it on, turn it up, so to say, than it is to be full blast all the time and have to figure out when to dial it back. Touched on this earlier in the last question, and that is that the trading week is much more important than the trading day. Of course, I want to do well every day, but it's how my results look at the end of each week that matters most. For options trading, I always need to give my best effort on Fridays. I get very upset with myself if I don't really give an A+ effort on a Friday, and that's because there's very little premium on weekly options by the time Friday rolls around, so that means that the smallest of moves in an underlying stock can cause solid 10 to 20% moves in the option chains. And if it's a big move happening, then you can see options moving hundreds and sometimes even thousands of percents. So I got to give that strong effort on Friday because there's tends to be, if I make 5 trades on average, Friday there tends to be an opportunity to make 15 trades. So kind of think about it like this. What's the most important quarter in a sporting game like football or basketball? It's the fourth. Well, Friday is the fourth quarter of our trading week. And lastly, I think I have talent, but sometimes I feel like experience and discipline holds me back. And so that's where I kind of came up with this mantra for myself, and that is that talent can win battles. My talent has gotten me out of some battles, but it's the experience and discipline that has helped me start to win the war here and get consistent on my progress. So a lack of talent, yeah, it might keep you from advancing, but I can tell you personally that a lack of experience and discipline is what will guarantee you don't get very far. And likewise, talent maybe will make you money, but it is the experience and discipline that will make sure you keep the money you make. I've got a final thing here to go over on level 2 footage, and what we're going to do is we're going to look at a lot of live footage from the live trading archive and go over things, and that'll wrap it up. But before I do that, because this is going to be it's just going to be film study right now. It'll be a film session here. And I've got 5 different videos to go over. But before diving into that, are there any questions on things that we've discussed to this point? Okay, doesn't look like it. Alright, so we're going to dive into some film study here, and what you're looking at right here is footage from Friday, October 30th, and it looks like it starts, the footage I want to show you starts at 9:35. So the purpose of this film study is just going to be looking at level 2 footage and level 2 action, and talking about how I use level 2 to help dictate my trades. So this is a setup on Tesla where the stock had gone down, gap down, and was kind of looking like a short on bounces to me. And what I'm looking at here on Tesla is I'm looking at the round level of 210, and I'm just watching to see how is it reacting around 210 as far as setting up a short trade. So what I'm doing is I'm looking at the 210 strike puts. I want to trade these, so keep your eye over here on the left hand level 2 box. That's where those 210 strike puts are trading. You'll see that when I do enter the position, it'll show up in the position with my average price. And then, but again, the main thing here on level 2 is we broke below 210, and I want to be getting commitment below 210. I know that 210 is a key level from the chart, but now I want to see what level 2 is telling me about 210. So I'm just going to let this play, let it run, and I will commentate along the way. So what I like is that you're not getting any bounces back above 210. It's kind of a slow pace right here, but the bears are in control. There's two key questions for me when I'm using level 2. Number one, who is winning the battle? Are the bids winning or are the asks winning? And number two, who is already in charge? So right here, the bears are already in charge. Why do I say that? Well, because the stock's down 0.6%. It gapped down. The bears have the benefit of the doubt. They've shown the better move out of the gate as the stock is moving lower. So I give them the edge right away. Then from there it becomes, all right, who's maintaining the upper hand? As long as the bears are keeping this thing down here, I know that they're in charge because the stock's already down, so I'm going to be short biased. So we had a couple chances where it tried to go above 210, but each time the asks ended up being able to come back down. Another attempt where, look at that stack, 209.90, right away it gets whacked out, asks still right at 210. So at this point I'm looking at that 210 put and I'm starting to think, okay, maybe I need to make an adjustment here if I want to get in. Doesn't look like I'm going to fill much lower, so I'm thinking about just jumping in. Here's another chance, right? Asks are above 210 this time, but we don't have any bids above 210. And then the ask comes right back down to 210. So keeps trying to go up, but ultimately the asks are able to come down. Here we finally, look at that. Got to rewind that because that's key when you see stuff like that. Pay attention. The bids are going to pop up to 210.20. You're going to get a lineup of bids at 210.20 for a second, and then it's going to whack them out right away. I'm going to pause it when it lines up at 210.20 to show this. See that? Look at this lineup. We've got 3 bidders at 210.20 and only one ask below 210.30, right? So right here is a chance for the bids. They've got a chance to start shifting the tide and firming this thing back up. But when I click play, you'll notice that instantly these bids get whacked out and the asks go right back to 210, and that kind of serves as a signal to me that there's still a lot of pressure here, and this is where level 2 really starts to be useful. Alright, so we whacked them out right away. You still have some bidders at 210. They're trying to stack again. 210.05 now on the bid. They have a chance, if they can take them out, but boom, ask right back down to 210. So the bears are still in charge. You can see I've started to raise a bid over on those 210 puts. I'm bidding $1.54. Again, asks right back at 210. So even though the stock isn't moving here, it's been at the same price for a couple minutes, I'm looking at this and I'm saying, number one, the bears are in charge because the stock's lower. Number two, the asks keep coming down to 210. Number three, it's going to move. It's going to move more than it's moved right now. I'll be damned if Tesla just stays at the same price all morning. So that's where I start placing that bet. You look over here, I did get in that 210 put. I bought one contract at $2.65. You can see it highlighted here on that level 2 area. And again, the main reason for this is I'm willing to bet on the bears. They are already in charge, and they look to be winning the battle on the level 2. The asks seem to be having an easier time going down than the bids do seem to be going up. We're still just dancing with 210. And to be clear, this is a little bit more of an aggressive trade because number one, it's still slow. And number two, it hasn't started that move. I'm trying to front run the move. I bought a put in anticipation of new lows based on what I'm seeing on the level 2. But maybe you're looking at it and you're saying, well, the bids keep firming up, it's defending 210. I'm going to wait until it starts to lose 210 more cleanly or more emphatically. But that's why, it's kind of my job to be able to anticipate these things. And this is another good one where we're getting these bidders back above 210. The asks are at 210.50. but you look at it and it'll be able to whack them out again right here. Bid's still holding 210, but still just no extension. We're not able to move through these low 210s at all, and because I know the bears are in charge, since the stock is already down 0.7%, they don't have to prove it to me. The bulls are the ones that have to change my mind. So when I'm in this put, I just want to see continued stalls on 210, and I want to be whacking out 210s here as we continue to progress and get closer to 9:45. Right now it's 9:37, only 7 minutes into the trading day here. So getting some ask stacking back down. Those bids still aren't looking aggressive. And now what I want to see at this point, since we've done a lot of dancing with 210, is the next time it breaks below 210, I want to be done with these tests back above 210. I've been in the trade for 5 minutes, which doesn't seem that long, but long enough for me. And since I'm more aggressive, I want to see the price action start to be supportive of my bias. Right now it is, I want to see it start confirming my bias. Right now it's supportive of my bias, but not yet confirming the belief that it is going to go lower. What will confirm it is a nice hard move back below 210 where the asks start stacking beneath 210 and we start pressuring that low again. So we whacked out the 210s, that's step one. Now you're getting some asks below 209, starting to speed up a little bit there. So I'm liking this. It is starting to confirm things here. And again, at this point, any flashes above 210 need to be coming right back down. If we're coming right back down from 210 at this point, I'm starting to really feel good that the move is underway. Okay, so here's a little flash where you took them back above 210. This is what I'm talking about, where now I want to see them be able to come right back down. What I like is no bids popped up above 210 on that. And the asks are right back at 210. Now we're back below 210, have some asks into 209s, starting to get some stacking, speed's picking up a little bit, order flow is picking up, and you can see that reflected over here in this 3-minute chart. You see the volume starting to increase. I don't need to look at the volume though to know that it's coming in. I can tell it's coming in from the way the level 2 is extending lower. And you look at that break, that's exactly what I need to see, right down to the low. And now I'm kind of in the driver's seat. This trade is working. So I want to rewind it just for a second to show that speed right there once we backed below 210, because that was really perfect. It was a great example of what you want to see in terms of confirming your bias. So we're below 210. Look at the way those asks picked up right there. You see that? Just going to do it one more time. Rewound again just for a second. Alright, so popped back, try to get above 210. I'm pausing it for a second. So right now, try to get above 210, the asks were able to come back down. From the moment I click play, I want you to count how many seconds it takes to get down to 209.50 and start pressuring the low. Because the best moves lower are when you get a quick reaction down, meaning that the asks just really start stacking at a fast pace and you start going right down towards the low. So I'm going to click play here and let's just count how long it takes. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it takes 10 seconds, and here we are moving right there. And 10 seconds, to be honest with you, is more than average. Ideally, it only takes 5 or 6 seconds, but still good enough. You know, it goes right down to the low, and I love the way that it keeps the pressure on here. I'm going to pause it again for a second. So right here, we made a new low. This is where you get into the decision point of, do I want to take profits at this new low, or do I want to keep holding? And one of the things I look for off of this is, when you're at a new low, what does the spread look like and what do the bids look like? When you go into a new low, are bids automatically coming back up, or are asks continuing to stay down? And in this case, what we're going to see is the bids are failing to come up. There's not a lot of enthusiasm, if you will, by the bids. There's not a lot of buying into new lows, which you guys know, when we go straight down, I like looking for a bounce. But if there's no bidders showing up on the level 2, then I know I can stick with it on the short side. So you break 208s, you're testing lows, you look at that ask stack right below 209 right away, and just continuing to go lower. I'm prepping a sell order here. Now, I'm actually making the mistake of what I mentioned earlier of not placing your sell order right away. So I'll be using some guesswork on this. But this is a Friday. Fridays, yeah, this was a Friday. Fridays, you generally have the chance for much bigger moves, so I'll tend to be a little bit more lenient with things. But anyways, so again, you know, try to get back above 209, but the asks are staying down. No real jumps by the bids. Next lineup isn't until 208.50. And you're testing that right here, continuing to get great stacks lower. Just look at that speed. That's awesome. Awesome speed right there. Now right around here though, it gets a little interesting because we go down to 208, and you are going to start to get some bid jumps off of 208. And the asks are going to let up a little bit. You see that right there? They let up just a little bit. So I rewound it to show it again. So I'm going to try and pause it when we have the pressure on 208. I'm going to show you how heavy the asks are, and in a split second later I'm going to pause it again, and you're going to see how the asks spread out a little bit. We're going to talk about what that means. So working on pressure, staying on the lows here. Again, I rewound it so you're looking at the same thing. So here comes the lower day, more lower days, right down to 208. Awesome down ticks. More down ticks, staying on the lows. Right on top of 208 here. Alright, now look at this. Your bidders are at 208. You've got a nice ask lineup at 208.35. You've just dropped straight down. Everything still looks good. I just placed a sell order on this put at $2.94. But I'm going to change that. And the reason I'm going to change that is because when I click play again, you're going to see these asks kind of scurry back up to 208.70. And when the asks kind of scurry back up like that, like you're going to see, it's the first sign that, hey, maybe this move down is a little bit exhausted and maybe it's going to try and bounce. So I'm clicking play on this 208 test, and pay attention to what happens on the ask side. They come down again, 208.33s, boom, right there. You see that? Now we're up to 208.66. So try to come down and break 208, but now we've got bidders popping off at 208, and the asks spread back up by 30 cents. So again, that's a sign that maybe there's a little bit of relief coming in, and right away when I see that, I'm going to start considering an adjustment and looking to sell my 210 put. You flashed back up to 209. So on this next move down, I'm going to lock in profits because I feel like I just saw some bid support come in, and more importantly, I feel like the ask pressure let up a little bit. So here it is again. You try and go down to 208 and try and break that new low, but you can't do it. I'm in this 210 put. I start lowering my sell order. Because again, did a good job coming down to 208. But because of the action I just saw previously, if it doesn't break right here, I got to get out. Because I'm thinking this thing might bounce back to 210. See, now I'm making my adjustment, finger over the trigger, ready to cancel my original sell order and just sell into the bid, since it doesn't look like I'll be getting filled at 294. There was another one where you tried to break lower towards 208, but the asks got taken out. You're trying it again right here, trying to break down at 208, but again the asks still getting taken back out towards 208.50. So I did exit the position. You can see it's closed off. I now have a closed P&L. And again, the reason I did that, I'm just going to rewind and show it one last time before moving on, is because when we try to come down to 208 again, the bids still jump up and the asks still spread out towards 208.50. So like right here, we're trying to get ask pressure again. Here it is. Perfect example again. Bids are at 208, asks pressuring 208.25s. Let's go ahead and break down at 208. If we break down at 208, I'll be able to get that sell order at 293 where I'm trying. But boom, takes the asks back out towards 208.49. So that's kind of looking a little bit iffy to me. That's why I make that adjustment. So that's example number 1. We'll get another one here. Any questions on that one? Or any general feedback? What's up? Did you have a question, or are you just saying it made sense? Okay. Would I be thinking that 208 level could be a level to get long? It depends how aggressive I want to be. In that particular case, no, because I was just pretty much straight biased on Tesla, straight short biased on Tesla. So I don't want to try and catch a 50-cent bounce if I think it might drop another $1 to $2. The risk and reward just wouldn't be there for me. But in an average case, hey, the second we're locking in profits on a short trade, what's the point of locking in profits on a short trade if we don't think it's about to go up? So at that moment, shouldn't we be considering a long trade? So that's kind of what pops into my head when I enter shorts or when I enter longs, is I think about the opposite trade and if I want to jump in. But again, just kind of depends on your aggressive level, on your level of aggressiveness versus conservatism. How do you want to play it? What delta was that long put? I don't know off the top of my head. I'd have to go look. Let's see. It was a 210 put with the stock at 210. I imagine the delta was probably at least 30 cents. And gamma was probably pretty high as well. For questions on deltas, though, I've got a video on the site that talks about why I trade the option strikes I trade, how I pick them and whatnot. If you go to the introductions for new members category, you'll see this one, why I trade the option strikes I do, where I explain how I choose the option strikes when I make my trades. So I can't tell you right off the bat. But if you watch that video, you'll notice that I'm not usually very scientific with my trades. I know some people really like analyzing the delta and the gamma and the vega and the IV and all that. Unless I'm shorting an option, I tend not to look at the Greeks too closely in the heat of the moment. Yeah, I mean, you've got a higher risk tolerance than me. A delta of 70 to 80 for me. I'll look at those deltas on Fridays and Thursdays when there's extremely low premium. But in a general case, that would be too high of a delta for me. I wouldn't be comfortable with that delta risk. But that's just me. All right, we're going to move on. This next tape is from 10/26, so October 26th, and I believe it's a chase trade on Google, if I remember correctly. No, it's not a chase trade on Google. Wait, maybe it is. We'll find out in a second as soon as my video starts working. Okay, you gonna work for me or not? Okay. Alright, here we go. It is working here. Alright, so setting this up, this is Google, and October 26th, stock was looking good to me. It had it was kind of consolidating underneath the highs. And again, this is a different type of level 2 trade, because this is going to be just a chase trade, an aggressive chase where the stock makes new highs, and I feel like I'm seeing really solid bid activity, so I just try and scalp a long trade. So I'm going to set this up. Alright, so I'm looking at Google here, and we're up near the high. We're just underneath the high, and there's a couple different things to make note of with this chase trade. Number one, it's 10:52. Alright, so we're an hour and a half into the day just about. Timing's important. We've gotten good movement on the stock. You look at yesterday's close, 719. You look at today's open, 720. We have directional movement. We have moved 9 points from the opening price, and we have moved 10 points from yesterday's close. That's important because since I've seen the movement today, I will be willing to bet on continued movement. I'm always more likely to bet on something happening that has already happened rather than bet on something happening that hasn't happened yet. So the fact that Google had shown movement to this point is very important for my bias in terms of being willing to chase this trade. So I'm going to watch the 7:35 strike calls, and this is going to be a very, very quick trade. I think it happens within 30 seconds. But again, the key is that it had shown movement. So usually I'm not the type of guy that buys new highs. I usually like waiting for the break. But because I've seen the movement and because I like the bid activity, I am going to do it. So on Google here, check this out. First of all, look how deep our bids are. Look how deep our bids are. 728.80s on the bid, and there's just like 1, 2, 3, 4, 5, like 15 of these bidders. Granted, they could be manipulative. We don't know that they're for sure real until they get tested, but I'll trust what I see unless I don't see it anymore. So I see these deep bids, I see the stock testing highs, and I like what I'm seeing from those deep bids, and also the thin asks. We have very thick bids, but very thin asks. We've only got 4 shares on the ask at $29.33, 6 shares on the ask at $29.40, 6 shares at $29.50. Just not a lot of asks compared to the bids. So when I see that, that gives me some encouragement to be a momentum trader here and chase the move. So I placed the bid at 450 on the 735 calls, but I don't fill, so I'm going to end up raising the bid, and I get in at 470. But look at these bids, the way we stack. That right there, I love. All right, rewinding it for a second. That is a key thing to note when you are deciding to chase. When you start getting the upticks, I rewound it about 40 seconds, and I want you to pay attention to the pace of the upticks. the pace of the upticks on the bids. There's one uptick on the bids. Oh, my dumbass switched to Tesla for a second. Okay, switch to Amazon. What are you doing? All right, more upticks on the bids, 728.40s. And the bids just keep upticking, 728.70s. Then we get the lineup in 728.80s. Just awesome upticks right there. So that's what gives me the confidence to chase this, because now we're above 729. And look at our upticks. 729.20s right away. So I'm seeing those strong upticks just underneath the high, and I'm thinking, man, based on these upticks, if this thing breaks the high, it's probably going to be able to move a couple points. Why do I think that? Number one, because of the upticks, and number two, it comes back to the movement on the day. It's made good movement on a day. It has a range of 10 points from the opening price. So my bias is that it'll be able to keep moving if it's able to make a new high. So I click play. I did just get in that 735 call at $4.70. Just looking to chase the new highs. I place an ask right away at $5. And what do I place it at? 20 cents, I believe. And look at this. We're testing 730. And just an awesome smash above 730. You see that? Get above 730. We're still getting upticks. You look at this 3-minute chart. The chart is looking sexy. But again, I don't necessarily need to look at the chart. It certainly helps for confirmation. But I know the chart looks good because of the activity I've already seen on level 2. And so I have my sell order placed at $5.20. This is just going to be nice and quick. There's the order in at $5.20. I'm just trying to sell into the new highs. Stock continues to uptick. We've got some asks stacking at 730.69. Takes them out. Testing 731, just continues to ramp higher. You look at those bids, we're still seeing great upticks across the board. Probably could have raised this sell order based on what I'm seeing, but I just stick with the 520. I did get filled at 520. You can see the closed P&L shows up. And now you get above 731, and look at your bids. Your bids are still climbing higher, upticking at a very, very fast pace. Alright, so I want to replay that and just kind of let the action speak for itself. And the main thing I want you to pay attention to is once we start getting above 729 on the bids, just look at how they don't stop. And on a stock like Google, which can move on air sometimes, I mean, we just saw a 3-point move in one candle. That's a big move because it has a relatively small float compared to something like an Apple or a Netflix. When you see those bids get super active like that without any ask pressure, pretty good chance you're going to get a decent move. Alright, so here we are, rewound it a few seconds back before the highs started getting made. And again, just pay attention to how the bids stay super strong and uptick very aggressively while the asks do not downtick or anything, and they stay thin, and it just continues to ramp higher. Here's the 730 test. Watch how quickly the bids get above 730 when it crosses above it. Boom. Awesome. Huge stack above 730. Very deep bids. Very little ask stacks. We finally get a little ask stack at 730.69 right here, but it takes it out right away. See that? So even when there was an attempt at some slight ask pressure, it's still just able to move right through it. Now we're at 731, and we end up seeing the same exact thing at 731 that we saw at 29 and we saw at 730. So that's that. So for me, personally, I'll be honest, this is my least favorite setup. I do not like chasing, but if I am going to chase, that's the type of action I want to see. Any questions on that? All right, last one. Well, maybe we'll do two more. Let's see, this is at 10:50. So this is October 2nd. Alright, oh, perfect. So look what we have here, guys. Remember that setup I told you is one of my favorite setups to trade? Where you just start going straight up. Alright, so this is one of my favorite setups that we talked about, that straight up move. You look at Netflix, we've got those 5 green 3-minute candles in a row, and we're testing the highs. So I'm going to look at a scalp trade for a short trade. I'm going to use shares in this instance. Just was more comfortable using shares as opposed to an option. But I'm using level 2 to really try and time my entry here. We've gone straight up. There's nothing on the chart that really suggests there's a short trade. This is just going to be a pure level 2. The only thing on the chart that suggests a short to me is the fact that we've gone straight up. So right there, we stalled just slightly under 103.70. Try to make a new high, but you slowed down just a tad. Back up on 103.70s. Can you push above it? Getting rejected. I just want to pause it for a second. Think about this action compared to what we just watched on Google. When Google made new highs, we saw her just ramp higher. Google was at 729, the opening price was 103. So we knew that there had been movement on the day. Similar time as well, it was about 1050. Here we are with Netflix though, it's about 1050. And the opening price was 103, and we're at 103.68. So there hasn't been movement. Alright, Google went straight up. Why didn't I short Google? Well, level 2 was super strong, number 1. And number 2, there had been good directional movement on the day. On this particular day, there has not been good directional movement by Netflix. So because of that, combined with the fact it's gone straight up, I'm leaning towards the short trade. And then once I see level 2 stalling on the new high a day attempt, that gives me the confidence I need to get in here for a short. So we're, again, continuing to test highs, and you just still can't really push through it. I hate when I jump to different screens in the middle of the trade. But anyways, so back here, and now we've backed away further from 103.70, still kind of stalling. And I place an order to short shares at 103.63 because of what I feel like is a stall. You can see my order is on the level 2 highlighted in gray here. On ask to short shares at 103.63. This is just going to be a scalp trade versus the high of day action because it's my setup that I like, the straight up move. And for all the reasons I've mentioned to this point, I feel like I have a short setup here for a scalp trade. I get filled. You can see it fills. It's highlighted in pink now, 103.63. I immediately place a bid to cover down near 103. And in fact, I try and short more at 103.63. I must have had a lot of confidence on this one. But it does not fill. And you can see me placing my bid to cover at 103. What did I go with? 103.13. So I'm trying to cover at 103.13. And when I lose 103.50, I want to be failing to come back up towards the high. Once I lose 103.50, I'm starting to feel like my scalp trade is being confirmed and I'm going to be going down towards my target. So this 103.50 reaction is going to tell me a lot about my trade. Testing 103.50. Alright, breaks below it, and right away you get asks beneath 103.50 and you come into the 103.30. So that's good. Now I can just trade versus break even. But again, nice reaction on that 103.50 break. So now anytime it tries to pop back above it, I want to be coming back down, whacking out those bids. Notice that it failed to get above 103.50 right there. Good ask stacks in the 103.40, 103.30 range. Best ask stack of the sequence, 103.37. Testing 103.30, trying to get into the 103.20s. Coming into 103.20s, 15 cents away from filling at this point. Looks good. And I fill at my 103.13 cover. So just a simple scalp off that high. And again, the key takeaways is, number one, the stock had not had good range on the day, unlike Google, which I just showed you previously, which had good range. So I'll have more confidence to short into the new high because I'm not a believer that it's going to start running to the upside like I was with Google. And then once I got that 103.50 breakdown, never try to come back above it. So that was good, nice and clean. We'll do one more since that was a quick one. Alright, this is from September 24th. Oh no, I know the one I want to show, I'm sorry. Scratch that. There was footage from today that I wanted to show. Today was an interesting day. It was very tricky. So this is from today, like I mentioned, and pretty early on in the day. And we're looking at Apple. I was looking at Apple, and this is a good example of a level 2 fake out. So the stock had made a new low, went down to 15.58, and then it popped back up to 16. So when I saw that pop up to 16, I was kind of optimistic. I thought, okay, this thing just came off of the low nicely, and maybe we are going to start running to the upside. So my trade setup at this point is just going to be kind of versus 116. So you're going to get a nice move here where it really starts pushing above 16, and this is why, like anything, there's no guaranteed strategy. I can try and be a pro at level 2, but I'm still going to get it wrong sometimes. And you're going to see that right here where Apple makes a really nice spike. I mean, 9 times out of 10, I will trade this that you're about to see, and I'll think there's some really solid upside coming. So you're kind of consolidating around 116 after coming off that low. And what I want to see to get me long Apple is I want to see a nice push above 116 back towards the opening price coming off of that low. Again, remember one of my favorite setups. It's a gap down that fails to break to new lows. That's what this is looking like. Apple gapped down, tried to break to new lows, but then started coming back up. So it's looking like one of my favorite setups, so I do get excited. Still waiting on confirmation though. Notice that when it came into the 1580s right there, it came right back up towards 116. Now you're getting above 16, you're starting to make a little push, but now you whip down 1590s, but whipping back up. This is a good example of whippy price action, where you're kind of whipping either way 10 cents right away. And now you start going. Look at that move right there. Nice quick 15-cent push. So just rewound it for a second. Again, check it out. When we pop above 16, we immediately push towards 1620s. And, you know, that gets me bullish. I place a bid on the 114 strike call. That doesn't end up filling. So because I can't fill the option, I end up just buying some shares at like 116.25-ish or so. And again, I'm just looking for some momentum. I feel like she's making a nice pop right here, right there, 116.20s. And she's just pushing. You can see I start getting an order ready on the shares. So what I'm seeing at this point is I feel like it was that setup where it failed to break lower, and now it's just going to start rallying higher. Doing a good job holding 1620s, not coming back down to 116, testing new 5-minute highs. So you can see I take shares, position is highlighted, I buy 30 shares at 116.30, and again, it just looks good. That's what I'm thinking. This thing looks good, and I'm looking for it to start rallying the highs. And you're continuing to hold the move. That's the important thing here. That's why I'm starting to think that it's going to be a pretty decent trade, because you're holding the 116 cross and you're adding to it. You know, you came up 116.40s, you're coming up near 116.50. Good solid reaction higher, testing 16.50. I'm looking for 117s. And then at some point here, something's going to go bad. It's just going to come back down and, you know, kind of negate the trade. But again, this is a good example of what I would call a level 2 fake out, where, you know, you get back to the two key questions. Who's winning the battle? Who is already in charge? In this case, the people in charge are the bears, because the stock is down. However, I feel like the bids are winning the battle because they've pushed it off of the low by 80 cents, and now we're only 20 cents, 25 cents off the high. So the bears are still in charge because the stocks are red, but I felt the bulls, the bids are starting to win the battle. So that's where I decided to get a little bit aggressive, make a little bit more of a guess. Did not have full confirmation, and it's just one of those things, you know, again, got to identify your style, identify how you're going to trade, how aggressive you're going to be versus how conservative you're going to be. Sometimes you're going to get it right, other times you're going to get it wrong. This is one of those instances where I get it wrong. Even on this pullback though, pulled back off of 1650, you're still around 1620s. You're not coming down hard, which is why I'm not exiting here, because I still feel like this thing's holding up pretty fine. Where I would start to get concerned is if you make a hard drop down to 116. You can go back to 116, it just can't be at a super fast pace. You want it to be kind of a slower move back down. Fast move up, if it's a fast move up and it's going to continue going, you want a slower move down. That right there was not a slower move down. Now we're starting to crash back towards 116, so I am a little nervous off of that. That's my first warning sign right there, guys. That's the first warning sign that I just got trapped, so to say. I rewound it for a second so we can look at that again. We're in the 1620s, and then in just about one tick you're going to go down to 1610 right away. See that right there in one tick, right down to 1610. So in hindsight, watching this on the film, should have just exited the shares right then and there once that caution showed up. I did not end up doing that. I ended up getting out like 1590s or so. As you can see, it kept going lower, so I did just kind of take a loss on this. But so that's a good example of trying to be aggressive and getting it wrong. And number two, level 2 showing you the warning sign. You know, when you dropped 15 cents in that one tick, that was a warning sign that for whatever reason I didn't respond well to, and I stuck with it. And you can see if we fast forward here, the stock just continued to grind lower and ultimately goes on to make new lows. And it was tricky though, because if we look at a chart of Apple later on in the day, she was such a little bugger today, because you can see this, here's the fake out, you go to new lows, fake out to new lows, come back up, come back down, and then around 11 o'clock you finally made that really hard push to the upside. So, you know, I got faked out on the first one. However, the trade did end up working, so you wanted to kind of come back to that at some point later on. So good example though of the fake out and of how level 2 can kind of show you that warning sign. And then thirdly, of how maybe the trade didn't work right then, but it can still possibly work at a later time. Alright guys, that's what I got for you here today. Are there any questions on anything you saw here? Happy to hear that, David. I hope you guys enjoyed it. Glad to hear you learned something. And I will see you tomorrow. If you think of any questions, just shoot me an email. This was recorded. It will probably get posted by this weekend at the latest. Hopefully it'll get posted by tomorrow if I'm not a lazy piece of crap. Alright guys, so I'll see you tomorrow morning. Have a good night. Thanks.